Welcome to our second class on the Introduction to Financial Markets. Today we will dive into a fundamental topic for any investor: the difference between direct and indirect investment. Understanding these concepts will help you make informed decisions on how to manage your capital in the market. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. If you're ready, let's get started. Direct versus indirect investment. Direct investment. Direct investment refers to when an investor purchases individual assets such as stocks, bonds, or derivatives on their own. This type of investment involves a higher level of responsibility and commitment, as the investor has complete control over their investment decisions. Let's break down some key aspects of direct investment. Responsibility and control. In direct investment, the investor is solely responsible for managing their assets. This means researching and analyzing the market, identifying opportunities, and deciding when to buy or sell. The absence of a standard strategy means that each investor must develop their own approach based on their knowledge and experience. Roadmap. It is essential to have an investment plan. This plan should include clear objectives. What do you hope to achieve with your investment? Are you seeking passive income, capital growth, or diversification? Time horizon. How long are you willing to hold your investments? Risk tolerance. How much risk are you willing to take? This will help you select the right assets. Types of assets in direct investment. Stocks. These are securities issued by a company that represent a portion of its equity. As a shareholder, you have economic rights, such as receiving dividends, and political rights, like voting at shareholder meetings. The return on stocks is variable and depends on the company's performance and market conditions. Bonds. These are debt instruments issued by companies or governments to raise funds. When buying a bond, you lend your money in exchange for fixed interest payments over a set period, and the return of principal at maturity. This means the return is more predictable and generally lower than stocks. Derivatives. These are contracts whose value is based on the price of another underlying asset, such as stocks, bonds, or indices. These instruments allow investors to speculate on the future direction of an asset without directly owning it. Derivatives can be highly leveraged, meaning they can yield large gains or losses with a relatively small initial investment. Indirect investment. Indirect investment refers to when an investor places their money in an investment vehicle, such as a mutual fund, pension plan, or ETF, exchange-traded fund. In this case, the investor entrusts the management of their assets to a professional or management team. Let's explore this type of investment further. Professional management. The main advantage of indirect investment is that you do not need to make investment decisions yourself. Fund managers are experienced professionals who analyze the market and select the most appropriate assets for the fund, based on specific criteria. This is especially useful for investors who lack the time or knowledge to manage their own investments. Diversification. Indirect investment vehicles, such as mutual funds and ETFs, allow investors to diversify their portfolios more easily and efficiently. By investing in a fund, your capital is spread across multiple assets, which helps reduce risk. Diversification is key to protecting against market volatility and significant losses in a single investment. Types of indirect investment products. Pension funds. These funds are designed to collectively manage the capital of multiple investors with the goal of generating long-term savings for retirement. These funds usually have long-term investment policies and can offer tax benefits. Pension plans. These are collective investment vehicles that allow employees and employers to contribute to a fund that will be invested to cover future pension needs. The liquidity of these funds may be lower than other financial products as they are meant for future savings. ETFs. ETFs are investment funds traded on the stock exchange, meaning you can buy and sell them like stocks. Their primary goal is to replicate the performance of a specific stock index or another asset. ETFs offer great versatility, allowing investors to access a wide variety of markets and sectors with a single investment. Opening a brokerage account. Whether you choose direct or indirect investment, you will need to open a brokerage account. This account acts as a depository for your assets and is linked to your checking account. Here are some important points about the brokerage account. Buying and selling process. When you buy a stock, it will be recorded in your brokerage account, and the cost will be debited from your checking account. When you sell a stock, it will disappear from your depository, and the sale amount will be credited to your checking account. Trading hours. It's important to understand how trading hours work on the stock exchange. Opening auction. Stock exchanges open at 8:30 a.m. for an opening auction. At 9 a.m., this auction ends, and normal stock trading begins. Closing auction. The closing auction begins at 5:30 p.m. and ends at 5:35 p.m. This period is crucial as it determines the closing price of stocks for the day. Technical analysis and types of charts. In technical analysis, charts are essential tools for investors. Some common chart types include line chart. Displays the price evolution of an asset over time with a continuous line. It is useful for seeing general trends. Bar chart offers more information than the line chart, showing the opening, closing, high, and low prices over a specific period. Candlestick chart provides a more complex visual representation where each candle represents a specific time period. These charts are popular among traders because of the information they provide about market psychology. Major global indices. Stock indices are a way to measure the performance of a group of stocks. Some of the major global indices include United States S&P 500, Nasdaq, Dow Jones. Europe, Euro Stoxx 50. Asia, Hang Seng, China, CSI 300, China. Nikkei 225, Japan. United Kingdom, FTSE 100. Latin America, Bovespa, Brazil. Germany, DAX. France, CAC 40. Netherlands, AEX. Italy, MIPTEL. Spain, IBEX 35. Diversification and asset allocation. Diversification is a key investment strategy as it helps mitigate risks by spreading capital across different types of assets. The three major markets to consider for proper asset allocation are money market. Includes liquid financial assets such as commercial paper, treasury bills, and certificates of deposit. These instruments are short-term, typically with maturities under 15 months. Fixed income market includes debt issues from governments and companies. Bonds and notes are issued in defined amounts and offer fixed returns through a coupon. This type of investment is considered safer compared to equities. Equity market includes company stocks and other equity instruments. This type of investment can offer higher long-term returns but also involves higher risk due to stock price volatility. Forex and derivatives markets. Foreign exchange market. Forex, the largest financial market in the world, where different currencies are bought and sold. It facilitates international transactions and allows investors and companies to convert one currency into another. Derivatives market, composed of financial instruments whose price depends on the value of another underlying asset. This market allows investors to speculate on future price movements and manage risks. OTC market, over-the-counter. These are off-exchange markets where financial instruments are traded directly between two parties, often through electronic networks. Stocks not listed on the exchange are traded in this type of market. Class conclusion. In summary, we've explored the difference between direct and indirect investment, the types of assets you can consider, and the key elements you should take into account when investing. This knowledge is fundamental to developing your investment strategy and managing your capital effectively. If you enjoyed this class, don't forget to like the video and subscribe to our channel so you won't miss our future lessons. By activating the notification bell, you'll receive alerts every time we upload new content. In our next class, we'll dive deeper into technical analysis and how to use it to make informed market decisions. Thank you for joining us, and see you in the next class of our Introduction to Financial Markets course.